Hey everyone, welcome to This Explainer. If you've been tracking the AI space lately, you probably know the narrative has totally shifted. The big story isn't just about clever chatbots or software automation anymore. No, it's about cold, hard infrastructure. We are talking about massive, incredibly power-hungry data centers packed to the absolute brim with thousands of Nvidia chips. And just this week, Wall Street made a monumental, totally unprecedented bet on that exact future. Nvidia announced a staggering financing partnership, essentially mobilizing massive amounts of capital just for AI compute infrastructure. But as we're going to see, the market's reaction was pretty surprising. So, is this a stroke of genius funding the next industrial revolution, or is it a massive flashing warning sign?
Here's our agenda for today's Explainer. First, Wall Street's huge AI bet. Second, inside the deal. Third, why the stock dropped. Fourth, the bull case for AI. And finally, what this means for investors.
All right, let's jump right into Section 1, Wall Street's huge AI bet, or as some are calling it, the $500 billion mystery.
$500 billion. I mean, just let that sink in for a second. To put that massive number into perspective, that's actually more than the entire GDP of countries like Austria or Singapore. That is the jaw-dropping amount of capital that Nvidia, working alongside a consortium of some of the biggest heavyweights in high finance, is looking to mobilize for AI infrastructure. Nvidia is stepping way beyond just selling chips here. They are signing memorandums of understanding to create massive, dedicated financing platforms. The whole goal is to raise this money from institutional investors. Think massive pension funds, insurance companies, sovereign wealth funds. It's basically an industrial-scale mobilization of capital, aimed squarely at building out the physical backbone of artificial intelligence.
Now, you'd probably think announcing $500 billion of first investment would send a stock absolutely to the moon, right? Well, actually, no. Upon hearing this news, Nvidia's stock fell by nearly 3%. It's a completely counterintuitive reaction, and it immediately signals that the market is cautious. Why on earth would Wall Street flinch at such a huge influx of capital into everyone's favorite tech sector? Well, to understand that, we need to look under the hood at what they're actually trying to build.
That brings us to Section 2, Inside the Deal, and how they're building the future.
Nvidia's CEO Jensen Huang actually uses a very specific term for this. He calls them AI factories. And we're not talking about your standard run-of-the-mill server rooms here. These are massive data centers, fundamentally designed from the ground up as revenue-generating assets. You kind of have to think of them less like traditional tech hardware and more like a physical toll road, or maybe a sprawling commercial real estate portfolio. They are hard, physical assets meant to generate ongoing yields. Basically, Wall Street is starting to view AI compute capacity not as a business expense, but as a brand new investable class of infrastructure.
And this brings us to the core reason why Nvidia needs Wall Street's help in the first place. Current estimates suggest that a staggering $3 trillion in AI investment is going to be needed by the year 2030. Now, traditionally, tech giants like Microsoft, Amazon, and Google have just paid for their own infrastructure straight out of their massive cash flows. But $3 trillion? Literally, even the mightiest tech balance sheets on the planet cannot fund that alone. The sheer physical footprint of this AI revolution has officially outgrown Silicon Valley's checking account. Basically, they need Wall Street's credit card.
So who exactly is stepping in to fill that massive funding gap? Well, just listen to the players involved in this consortium. BlackRock, Apollo, Goldman Sachs, Brookfield, Blackstone, KKR. I mean, that is the absolute heavyweight division of global finance. But maybe the most absolutely crucial detail here is Nvidia's role. To give these institutional investors the confidence to jump in, Nvidia actually holds the option to backstop up to 25% of these deals. That represents roughly $125 billion of Nvidia's own skin in the game, acting as a massive financial safety net for the banks.
Which leads us perfectly into Section 3, Why the Stock Dropped, Exploring the Bear Case. The primary anxiety right now stems from history. Critics are pointing out a pretty uncomfortable parallel to the dot-com crash of the late 90s. Back then, telecom giants like Lucent Technologies effectively financed their own customers, just so those customers could afford to buy Lucent's networking gear. It artificially inflated demand, and it created a huge bubble that eventually ended in disaster. Today, skeptics are looking at Nvidia putting up a $125 billion backstop, and they're seeing the exact same thing, the Nvidia loop. Are they just financing their own customers to buy their own chips? It really blurs the line between genuine organic demand and demand that's just artificially propped up by vendor financing.
Breaking it down, the market is really grappling with three core anxieties. Step one is that circularity problem we just talked about, the deep fear of artificial demand. Step 2 is concentration risk. By pulling in pension funds and insurance companies, we are basically concentrating massive global financial exposure into a single, highly specific tech sector. If AI adoption slows down even a little, those losses will ripple right through the retirement accounts of everyday people. And step 3 is the macro environment. We are currently living in a high-interest rate world, which means debt is expensive. Betting that brand-new, rapidly evolving AI technology will generate stable enough yields to pay off that expensive debt, that's a very, very big gamble.
But let's flip the coin. Section 4, the bull case for AI and the argument for a new asset class.
Now, Jensen Huang has forcefully pushed back against those lucid comparisons. His defense rests entirely on the nature of the money being raised here. As he puts it, this is independent, long-term, institutional capital. The bulls are arguing this isn't Nvidia lending money to a scrappy startup so they can buy GPUs. This is bringing in mature, third-party money that has absolutely zero contractual obligation to buy Nvidia chips. It's a fundamental structural shift in how compute power is funded, and it's effectively attempting to completely bypass that whole circularity fear.
We are actually seeing a massive shift in perception happening on Wall Street right now. The old view was all about the fear of a speculative AI bubble, but the new institutional view? It treats AI data centers like predictable utilities. Remember, pension fund managers aren't looking for a quick tech stock pop. They need reliable assets that generate predictable cash flows over 10, 20, or even 30 years. With long-term power purchase agreements and committed lease contracts in place, these AI factories start looking incredibly attractive to them. The bulls argue this is just the natural evolution of how computing power is delivered, very much like the historic shift from on-premise servers over to cloud computing.
So let's wrap this up with Section 5, what this means for investors and how to navigate this new landscape.
The absolutely crucial point here is how this macroeconomic news filters down to your specific strategy. If you're an equity investor, you need to understand that this deal introduces some new volatility. The market is clearly nervous about the financing complexity. Keep a really close eye on credit spreads. Actually, Nvidia's 5-year credit default swap widened after this announcement, which means the market is pricing in slightly higher risk on Nvidia's debt. Now, if you're an income-focused investor, this is super fascinating. This deal basically opens the door for brand new institutional-grade AI debt products. You might soon start seeing private credit funds and bonds tied directly to AI infrastructure yields. And finally, for the retail investors out there, the takeaway is pretty simple. Don't get swept up in the daily headlines. These financing structures are getting incredibly complex, which makes diversification your absolute best friend. Seriously, don't bet the farm on one single company.
Which leaves us with this final, truly monumental question. As the rapid innovation of Silicon Valley collides head-on with the complex engineering of Wall Street, what are we really looking at here? Are the bears right, and we're just witnessing the complex financial engineering of a speculative bubble that's destined to pop? Or are the bulls right, and we're literally watching the real-time birth of a foundational new asset class that's going to power the global economy for decades to come? Well, the truth, as is so often the case, will probably fall somewhere right in the middle. But one thing is absolutely for sure. The winners of the next decade will be the folks who take the time to really understand both the underlying technology and the high finance backing it up. Thank you so much for joining me for this explainer. Keep learning, stay diversified, and I will catch you in the next one.